Hi, everyone. Want to talk to you today about rate hikes. This is really the topic everyone's concerned about, everyone's talking about. And the question people are asking is, will a rate hike kill the bull market? So we have the S&P 500 in this chart and the 3-month treasury rate. And what we're seeing here is some weakness in stocks. So there's been a correction of around 12% in the S&P since the start of the year. And at the same time, you have that 3-month treasury rate moving straight up on the expectation that the Fed is going to start hiking rates in March. So naturally, people are tying the two together. They're saying stocks are going down because the Fed is going to start hiking rates, and people are worried. They're thinking that this is going to lead to a bear market in stocks. And that's certainly a possibility that could happen, but I think people should be aware that there are other possible outcomes as well. And for that, let's take a look back in history and see what happened at the start of prior rate hike cycles. So December 2015, that's the last example we have. The Fed at this point had not hiked rates off of zero for 7 years. So they kept interest rates at 0% for 7 years. They finally hiked rates in December 2015 to a range of 25 to 50 basis points. And what happens in the stock market at that point? Well, initially you see some weakness. There's a correction in the S&P 500, as you could see over here. But then there's a recovery, and the Fed would go on to hike 6 more times before the S&P peaks in September 2018, and you have a gain of close to 50% in the S&P over that period of time. So that's the 2015 example. How about before that? Well, before that, we have June 2004. In June 2004, similar to 2015, the Fed had not hiked rates in quite some time. They moved 25 basis points to 1.25%. Now, at the time, that was considered low, 1%. The Fed had kept rates at 1% from June 2003 to June 2004. Many thought that this was one of the proximate causes of the housing bubble, but the Fed finally starts hiking rates in June 2004. And what happens in the market? Well, we see a similar weakness to 2015. So you see a minor pullback here in the markets, but eventually stocks recover, and the Fed would go on to hike 16 more times before the S&P 500 peaks in October 2007. So over this period of time, stocks go up close to 46%. The economy doesn't go into a recession until early 2008. And so you have another example where stocks have continued higher in spite of multiple rate hikes. Next, we have June 1999. So this was in the middle of the dot-com bubble. The Fed hikes rates 25 basis points to 5%. And what happens in stocks? Well, you see something similar to the prior two examples. You see some weakness here where the stock's moving sideways for a number of months. They end up recovering, but the Fed does hike 4 more times before the S&P 500 peaks in March 2000. And the S&P really doesn't tell the whole story during this period. A lot of the gains were concentrated in tech stocks. So if we look at something like the NASDAQ 100, it more than doubles during this period of where the Fed hiked rates 5 times. Now, in terms of the economy, you didn't see a peak in terms of the economy until 2001. You had a recession there start around March 2001. Before that example, we have 1994. So in February 1994, the Fed finally starts hiking rates for the first time in that cycle. Prior to that, you had a recession in 1990 to 1991. And the Fed hikes rates here 25 basis points to 3.25%. So what do we see in the markets? Well, once again, we see some minor weakness, pullback in stocks. S&P kind of trades sideways during that entire period in 1994. Then goes on to have one of its strongest runs in history, where it advances 179% from that first rate hike. So the Fed hikes 7 more times during this period until the S&P peaks there in July 1998. So what do we learn from these examples? Is it to say that the same thing will happen today? No, most definitely we won't see the same thing happen, because every time is different. So even looking at these examples, these 4 prior examples, we see that they're all different. So they're different from where they started to hike rates to where they hiked rates. So in 2015, you're hiking rates off of 0. In 1999, you're hiking rates from 4.75% to 5%. They're different in terms of how many additional rate hikes there were before the bull market ended. So in 1999, you had only 4 more hikes, but in 2004, you had 16 more hikes. They're different in how long the bull market continued for. So in 1999, it continued for only 9 more months. But in 1994, you had 4 years and 5 months until the S&P 500 peaked. And lastly, in terms of the S&P 500 gains, you have really a wide range of price gains from that first hike. So what are we going to see today? Should we expect something similar to any of these periods? We know for sure that it's going to be different. How do we know that? Well, today is different than any of these periods. We have something really we've never seen before in markets and the economy, where we have a 7.5% inflation rate, we have 4% unemployment rate, and we still have the Fed funds rate, if we're looking at the lower bound, at 0. So to expect that what's going to happen next is the same as what's happened in the past would probably be a mistake, because what's going on today is nothing like what we've seen in the past. The Fed is just much easier than they've ever been, given where the inflation rate is and the unemployment rate is. And to drive that point home, if we look at this chart here, it's showing prior periods where the unemployment rate was 4%, as it is today. And what we see is a higher Fed funds rate every single time, and much higher real Fed funds rate. So if we subtract the prevailing inflation rate, what we see today is the most steeply negative real Fed funds rate that we've seen almost ever in history, and certainly the lowest we've ever seen, with the unemployment rate at 4%. So how many times will the Fed hike interest rates this year? The honest answer should be nobody knows. It's really dependent on a lot of factors. It's dependent on the trajectory of employment. It's dependent on the trajectory of the inflation rate, and it's dependent on markets, because the Fed, we know, is very closely watching the direction of markets. But I put this poll out a few weeks ago asking how many times will the Fed hike rates. It seems many people are skeptical that the Fed will indeed hike 4 times or more. The current market expectation is for 6 or 7 hikes this year. And many people think it's less, and going to be less than that. And many people are hoping that it's going to be less than that. And a lot of people are arguing that the Fed shouldn't hike rates, and they would prefer to see easy money continue for some time. And on that point, I would ask that question to people: would you rather see easing or tightening? And the answer really should be it depends on what's going on in the markets, what's going on in the economy. But this notion that you should always want to see the Fed easing rather than tightening, I think, is a mistake. And we only need to look at the last 2 major bear markets to see really that play out. So here's a chart showing the S&P 500 from 2000 to 2009. As you could see, we had 2 major bear markets during this period of time. You had a over 50% decline from March 2000 to October 2002. And what was the Fed doing during this period of time? They were cutting rates. They were easing policy pretty much the entire way down. So that didn't prevent the economy from going into a recession in 2001, and it didn't prevent a 50% bear market. Same situation in 2007 to 2009. You actually had the Fed cut rates starting in September 2007, so a month before the market's peak. They started cutting rates, and they continued to cut rates all the way down to 0 in December 2008. So did that stop a recession, the worst we've seen since the Depression? No. Did it stop a 57% bear market? No. So I think for people who are saying that a rate hike is necessarily bearish, or you don't want to see any rate hikes at all, and you'd rather see the Fed cutting rates or pausing here or continuing with easy monetary policy, that may be the case, but it's not necessarily true. I'd say if you're really hoping that the Fed is not going to hike rates at all this year, that would be a mistake. Be careful what you wish for, because it'll likely mean that the economy and the markets are in a very bad place. So we'll see what happens this year. Anything literally could happen. What the purpose of studying history is really to show you that there are many possible outcomes, and you can't say for sure what's going to happen in the future. But we know, looking at the past, that there's many different paths the market could take. So we could be going into a bear market here, but as we've seen from history, it doesn't necessarily have to be the case just because the Fed is hiking rates. So thanks everyone for watching. We'll see you again soon.